The internet has been free your entire life. You were born into it. You grew up assuming it would always cost nothing to search, stream, scroll, watch, post, and consume. Your entire behavior as a consumer, as a creator, as an investor was built on that assumption. And then in January of 2026, a law passed that nobody outside of telecom boardrooms actually read, and the assumption quietly died. The platforms you use every day started receiving invoices. The infrastructure that delivers free content to your phone started getting priced, and the people who understood what was actually happening bought certain assets before the press release. The people who didn't are still writing comments asking if this is real. So here is the question. If the free internet was always a business model and never a public good, what happens to your money the moment that business model breaks? We're going to explain exactly how this works and why it's getting very weird very fast. The central metaphor I want you to hold in your mind for this entire video is a toll road, because that is precisely what just happened. The internet was a highway. For 30 years, nobody charged you to drive on it. You drove, you consumed, you built businesses on it. You assumed the road would always be free because the road had always been free. But roads are not free. Roads cost money to build, money to maintain, money to expand. Someone has to pay for the road. And for 30 years, that someone was a combination of advertising revenue, venture capital, and an implicit government agreement to treat broadband infrastructure as a competitive utility. That agreement just ended. The toll booths are going up. And the question is not whether you will pay. The question is whether you will pay as a user, as a subscriber, as a shareholder, or as someone who got completely left behind while other people position themselves correctly. Hold that image. Toll road. We will come back to it. Now, let me explain what the law actually says, because most people are getting this wrong in a specific and predictable way. The law is called the Digital Infrastructure Equity and Access Act. It passed with bipartisan support, which should immediately tell you something, because bipartisan support in 2026 means telecom lobbyists talk to both sides of the aisle before the vote. The core mechanism is this. Internet service providers can now charge what the law calls a quality of service differentiation fee to large-scale digital content providers. In plain language, a company like a major streaming platform, a search engine, or a social media network can now be charged by the ISP based on how much bandwidth their service consumes on that ISP's network. If you are Netflix and your traffic accounts for 15% of total downstream bandwidth on a given network, the ISP can invoice you for that consumption. If you are a search engine serving billions of queries per day, same deal. If you are a platform delivering short-form video to 300 million daily active users, same deal. Now, the law includes language about consumer protection and competitive fairness. That sounds very reassuring until you actually read it. The Consumer Protection Clause says that ISPs cannot directly pass the fee to consumers in the form of a line item charge, but it says nothing about indirect pricing. It says nothing about raising base subscription rates. It says nothing about the platforms themselves adjusting their free tier offerings to compensate for the new infrastructure costs. The law is very precise about what it prohibits and very quiet about everything adjacent to what it prohibits. That gap between the prohibition and the adjacent behavior is where the actual money is moving. This is the first thing people get wrong. They hear the law bans charging consumers directly and they think, okay, so nothing changes for me. But you are not living in a law. You are living in a market, and a market does not care about legal language. The market finds a path of least resistance to price recovery, always. Let me give you the toll road version of this. Imagine a toll road company is legally prohibited from charging individual drivers, but they are allowed to charge trucking companies. So they charge the trucking companies. The trucking companies add the toll cost to their shipping rates. The shipping rates increase the cost of goods at every store the truck's delivered to. The individual driver never pays a toll, but the individual driver pays more for everything. The law kept its promise. The market did what markets do. That is what's happening to your internet right now. Here is the scale of what we are talking about, because I want you to feel the actual size of this before we go further. The top 5 digital content platforms collectively represent somewhere around 65% of all consumer internet traffic in the United States. That is not a statistic I invented to sound impressive. That is the consequence of 30 years of winner-take-all network effects, compressing the entire attention economy into 5 companies. When the ISPs send invoices to those 5 companies, they are effectively invoicing 65% of the internet. The estimated annual cost passed through to those platforms under the new fee structure is somewhere between 18 billion and 24 billion per year across the industry. That is not a rounding error. That is a structural shift in the cost basis of every free service you use. And here is where it gets interesting from a money perspective, because 18 to 24 billion dollars per year does not disappear. It moves It moves from the balance sheets of content platforms toward the balance sheets of infrastructure companies. It moves from free tier offerings toward paid tier offerings. It moves from small creators who depend on algorithmic distribution to larger creators who can be monetized more efficiently. It moves from consumer surplus to corporate margin. Understanding where money moves when a system gets repriced is the entire skill set here. This is not about whether the internet ends. The internet does not end. The internet gets restructured, and restructuring always creates losers on one side and winners on the other. The toll road is getting built. The question is whether you own shares in the toll road company, whether you are a trucker who now has to negotiate pricing, or whether you are a consumer who just sees the grocery bill go up and does not quite understand why. Let me walk you through the 4 ways this plays out, because they are not equal and they are not obvious. The first way this plays out is the most visible and the least important. Subscription prices go up. You have probably already seen this. Some platforms announced moderate price increases in the first quarter of 2026. Most framed it as infrastructure investment or content expansion or whatever euphemism their communications team preferred. A few were more direct. The math is not complicated. If a platform's infrastructure costs increase by $2 billion annually and they have 200 million paying subscribers, that is $10 per subscriber per year in cost recovery. Spread across a monthly price increase, it rounds to less than $1 per month. Not enough to cause mass cancellations, enough to quietly restore margin. This is the boring version. Most people stop here. Most people think this is the whole story. It is not the whole story. The second way this plays out is more structural and more important for anyone trying to understand where the leverage is. Free tier compression, this is the part nobody is talking about on mainstream finance channels. The entire advertising supported free tier of the internet is built on a subsidy. The subsidy is cheap infrastructure. When you watch free content on a platform and see ads, the revenue model only works if the cost of delivering that content is low enough that advertising revenue exceeds delivery cost. For 30 years, infrastructure costs were suppressed by competitive pressure, regulatory ambiguity, and the implicit understanding that ISPs would not bite the content hand that fed user adoption. That suppression is ending, and when the delivery cost of free content increases, the economics of the free tier deteriorate. Platforms respond predictably, they reduce free tier quality, they compress free tier access, they push harder toward paid conversion, they let the free experience degrade gradually enough that users do not quit in protest, but just enough that the value proposition of paying becomes clearer. Here is the number that should anchor this for you. The average advertising supported free user generates somewhere between $3 and $7 per month in revenue for a content platform. The average paid subscriber generates somewhere between $12 and $18 per month. The cost difference between serving those two users is not always proportional to the revenue difference, which means when infrastructure costs rise, the platforms have a very clean mathematical incentive to accelerate the conversion from free to paid. The law did not create this incentive, the law intensified it, and intensified incentives produce predictable behavior. Think about the toll road. When tolls go up, the trucking company does not stop running trucks. It audits which routes are profitable and which are not. It cuts the unprofitable routes first, the free routes get cut, the paid freight keeps moving. Now you might be thinking, okay, this just means streaming gets more expensive, I get it. But here is why that framing misses the actual consequence. The free internet is not just entertainment. The free internet is a distribution infrastructure for the entire creator economy. Every independent journalist, educator, analyst, and creator who built an audience on the assumption of free algorithmic distribution is now operating on infrastructure whose cost structure just changed. The platforms that distribute their content are going to become more selective about what they distribute for free because free distribution now costs more. The selection criteria will favor content that converts to paid subscriptions, content that generates premium advertising revenue, and content from creators large enough to absorb promotional investment. The small creator with 200,000 subscribers and strong organic reach is not going to be dropped overnight. They are going to experience a slow friction increase, slightly lower algorithmic promotion, slightly less favorable monetization splits, slightly harder to grow. The system is not going to announce that it is squeezing them out. It's just going to make everything slightly harder in ways that individually seem like noise, but collectively add up to a structural disadvantage. This is what I mean when I say attacking incentives instead of individuals. The platforms are not evil for doing this. They are responding to a cost increase exactly the way any rational business does. The law created the incentive, the market is executing on it. And if you are a creator or an investor who does not understand the incentive structure, you are going to experience the consequences without understanding why they are happening. If you are finding this useful and you want to keep thinking about systems and money in this way, subscribe. Not because I asked nicely, but because this channel is specifically built for the kind of analysis that most finance content skips. You will want the next video. The third way this plays out is where it gets counterintuitive. And this is the part that most people miss entirely because they are too focused on the consumer-facing price changes. The law creates a structural moat around scale. Let me explain what I mean by that. A small platform, a mid-tier streaming service with 15 million subscribers, faces the same quality of service fee structure as a dominant platform with 200 million subscribers. But the dominant platform has something the small platform does not have: negotiating leverage. When your platform accounts for 18% of total internet traffic in the United States, you are not a passive recipient of an ISP invoice. You are a party with leverage. ISPs need your content to justify their own service value. Consumers choose broadband providers partly based on which services run well on that network. This is called the eyeball network dynamic, and it means the largest content platforms have real bargaining power in the fee negotiation that smaller platforms do not have. The result is predictable if you understand how oligopolies work. The dominant platforms negotiate favorable rate structures, sign long-term infrastructure agreements, or simply absorb the fees because their margins can handle it while their competitors' margins cannot. The mid-tier competitors cannot negotiate the same rates. Their cost per unit of traffic is higher, their margins compress faster, some of them raise prices more aggressively than the dominant platforms, which accelerates user migration to the dominant platforms. Some of them cut content investment to protect margin, which accelerates user migration to the dominant platforms. Either way, the dominant platforms gain relative market share without doing anything except surviving a cost increase their smaller competitors could not absorb. This is the classic moat deepening mechanism. It happens every time a regulatory change increases the fixed cost of operating in an industry. The large incumbents who can absorb the fixed cost gain share from the smaller players who cannot. The regulatory change looks like consumer protection on the surface. It functions as competitive consolidation in practice. The toll road does not hurt all truckers equally. It hurts the small trucking company with thin margins first. The large trucking company with efficient routes and negotiated volume discounts absorbs the cost and gains market share. I want to give you the math on this because the math is important. Suppose a mid-tier platform has $100 million in annual operating profit. The new fee structure adds $30 million in annual infrastructure costs. Their operating margin compresses by 30%. They respond by cutting their content budget by $20 million and raising subscription prices by $12 per year on average. At 2% annual churn from the price increase, they lose about 1 million subscribers over 12 months. Their platform becomes slightly less valuable, their stock trades lower, they become an acquisition target. The dominant platform acquires them at a distressed valuation, absorbs their subscriber base, and their infrastructure cost per user actually decreases because the combined entity has more negotiating leverage with ISPs than either company had separately. The law that was supposed to make the internet more equitable produced exactly one outcome at scale: more consolidation. You think the problem is that the internet is getting more expensive, but actually the problem is that the internet is getting more concentrated. The price is the visible symptom. The concentration is the actual disease. The fourth way this plays out is the one that nobody is talking about because it requires thinking 2 steps ahead, and most people stop at 1. The law changes the economics of content creation in a way that eventually changes the composition of content itself. Follow the chain. Platforms face higher infrastructure costs. They need to extract more revenue per unit of traffic. The highest revenue per unit of traffic comes from content that drives paid subscriptions or extremely high value advertising. High value advertising concentrates in a very small number of content categories, primarily finance, real estate, legal services, insurance, and luxury goods. Content that does not serve a high value advertiser demographic or drive paid conversion has a declining value to the platform from a pure revenue per traffic unit perspective. The platform's content recommendation system is already optimized for engagement. When the cost of delivering engagement increases, the optimization tilts harder toward monetizable engagement. Content that generates high engagement but low monetization starts getting deprioritized in ways that are subtle, algorithmic, and very difficult to attribute to the law. And here is the part that should make you think carefully. The people who built small businesses on free algorithmic distribution of informational content are operating in a slowly deteriorating environment, not collapsing, deteriorating. The reach is slightly lower, the monetization is slightly harder. The conversion from audience to revenue is slightly less efficient. Over 2 years, this adds up to a business that is structurally weaker than it was before the law, even if nothing dramatic happened on any given day. The toll road metaphor again. The roads are not blocked, the tolls just went up slightly. But if your entire business model depends on moving goods cheaply across those roads, the margin compression is real, even if the drama is absent. Now, let me walk you through a specific scenario that illustrates how this creates both a threat and an opportunity, depending entirely on which side of the capital equation you're on. Imagine a creator, let's call him Marcus. Marcus built a finance education channel over 3 years. He has 400,000 subscribers. He generates about $12,000 per month from ad revenue and another $8,000 per month from a paid community he built alongside the channel. $20,000 per month. solid, not life-changing, but genuinely sustainable. Marcus's entire revenue model depends on two things. One, the platform continuing to recommend his content to new audiences at roughly the same rate it has been. Two, the advertising CPM on his content staying at roughly its current level. Here is what happens to Marcus under the new law. The platform, facing increased infrastructure costs, begins prioritizing algorithmic distribution towards content that either drives paid subscriptions on the platform itself or generates premium advertising revenue. Finance content is a high CPM category, so Marcus is relatively better positioned than, say, a gaming creator or a lifestyle vlogger. But the platform's paid subscription push means that organic reach for content like Marcus's gets quietly compressed in favor of content specifically designed to sell the platform's own premium tier. Marcus sees his monthly new subscriber growth drop from around 8,000 per month to around 4,000 per month over the course of 6 months. His ad revenue drops from $12,000 per month to about $9,000 per month as the overall platform CPM shifts in response to advertiser targeting changes driven by audience fragmentation. His paid community revenue stays roughly stable because those are existing relationships, but his growth has effectively halved. Marcus does not get a notification about this. He does not receive an email explaining the systemic reasons for his deceleration. He just sees his analytics slowly trending in the wrong direction and tries harder. He posts more frequently, he experiments with thumbnails, he reads articles about algorithm changes. He does all the things creators do when they think the problem is content quality or posting frequency, because those are the variables he can see and control. He never thinks about infrastructure cost, pass-through dynamics, and moat deepening mechanisms, because those are not the frameworks creators use to explain their analytics. Meanwhile, a different person, let us call him Daniel, looked at the same law and thought about it from an ownership perspective. Daniel has been investing in telecom infrastructure REITs for 2 years, not because he predicted this specific law, but because he understood the general direction of the infrastructure economy. Data consumption is growing, infrastructure is a regulated bottleneck. Regulated bottlenecks with growing demand tend to produce durable cash flows. When the law passed, Daniel's infrastructure portfolio did not explode overnight. It repriced upward over 6 months as institutional capital recognized that the toll road was now legally sanctioned. His position in a mid-tier telecom infrastructure fund went from a cost basis of around $40,000 to a current value of around $60,000 in 11 months. Not spectacular, not speculative, just a mechanical consequence of a law that redirected money toward infrastructure ownership. Marcus is working harder. Daniel is richer. The difference between them is not intelligence or discipline or content quality or networking. The difference is which question they asked when they heard about the law. Marcus asked, how do I adapt my content strategy? Daniel asked, who gets paid when the toll goes up? This is not a criticism of Marcus. He is asking the question that his training prepared him to ask. The system trained creators to think about content variables because content variables are the ones creators can control. The system did not train Marcus to think about regulatory dynamics and capital positioning, because that is not what content platforms want their creators thinking about. Content platforms want creators thinking about content. That is how the platform gets better content. The incentive to keep creators focused on creation rather than on ownership is not a conspiracy. It is just a feature of how every platform's incentive structure is designed. The toll road does not benefit from truckers who understand toll road economics. It benefits from truckers who drive efficiently and focus on their routes. Okay, so I said there would be some comedic relief in here, and I have been deeply serious for several minutes, so let me take 30 seconds. The most optimistic take on the new law I have read was from a think tank that described it as, quote, a market-based solution to the digital infrastructure funding gap that aligns incentives across the broadband ecosystem. I want you to picture the 17 consultants who sat in a room and drafted that sentence, and then I want you to picture them billing $400 an hour while doing it. The irony that this language describing the end of free internet was itself produced behind a very expensive paywall is the kind of thing that would be funny if it were not literally the whole point of the video. Also, the most common consumer response I have seen online is people saying they are going to use a VPN to avoid the new internet charges. Just to be clear, a VPN does not affect anything I just described. It does not change your platform's subscription cost. It does not change advertising economics. It does not change infrastructure fee negotiations between ISPs and content platforms. What a VPN does is encrypt your traffic from your device to a VPN server. This is useful for privacy. It is not a financial strategy. It is not an investment thesis. Using a VPN to resist the end of free internet is the equivalent of carrying your own toll money in exact changes of protest against the existence of the toll booth. Spiritually admirable, financially irrelevant. Okay, back to systems. Let me now talk about what is actually worth paying attention to from a money perspective, because I do not want this video to just be a description of a problem. The value is in the map of where the money is going and how you position around it. There are three structural beneficiaries of the new law, and I want to walk through all three clearly. The first structural beneficiary is physical infrastructure, fiber networks, data centers, tower infrastructure, cable infrastructure. These are the toll roads. The law just legally formalized their right to collect tolls. Companies in this space are not flashy. They do not trend on social media. They do not have charismatic founders giving keynote speeches about changing the world. They build physical infrastructure and then they charge people to use it. The new law expanded their pricing power, expanded pricing power on an asset with high fixed costs and low marginal cost of additional revenue is the definition of margin expansion. You do not need to pick individual stocks here if you do not want to. Infrastructure-focused ETFs and REITs in the telecom and data center space have been the quiet beneficiaries of this structural shift. This is not a prediction. This is a consequence that is already partially priced in, meaning you are not getting in at the absolute bottom, but the repricing is not complete either because institutional capital moves slowly and most retail investors are focused on the consumer-facing drama rather than the infrastructure layer. The second structural beneficiary is the dominant platforms themselves, with an important caveat. I said earlier that the dominant platforms benefit from moat deepening relative to smaller competitors. That is true at the industry level, but within the dominant platforms, the benefit is not uniform. Platforms with genuinely strong paid subscription businesses benefit more than platforms that are still primarily advertising dependent. The fee structure increases the cost of the advertising model faster than it increases the cost of the subscription model. A platform that generates 70% of its revenue from subscriptions and 30% from advertising faces a fundamentally different cost revenue dynamic than one that is 90% advertising dependent. The subscription model can absorb higher infrastructure costs more cleanly. The advertising model has a more complex transmission mechanism where the increased cost first compresses free tier offerings, then changes audience demographics, then changes advertiser targeting efficiency, then changes CPM rates in ways that are hard to predict with precision. The practical implication is that when you are looking at large digital platforms as investments, the law is an accelerant on a trend that was already underway, which is the shift from advertising-led revenue to subscription-led revenue. Platforms that had already moved significantly towards subscription revenue are better positioned. Platforms that are still heavily dependent on advertising face a more complex adjustment. This is not a timing call. This is a structural observation about relative positioning within an asset class. The third structural beneficiary is perhaps the least obvious: businesses that do not depend on the consumer internet at all. I am being slightly provocative here, but follow the logic. If the cost of reaching consumers through digital advertising increases, because platform economics shift in response to higher infrastructure costs, then the cost of customer acquisition through digital channels increases. This increases the relative advantage of businesses with strong direct customer relationships, strong brand equity that does not depend on paid digital acquisition, and strong offline or hybrid distribution. The toll road raises the cost of digital freight. Businesses that ship less digital freight, businesses with high customer retention, high word of mouth acquisition, or strong owned distribution channels are relatively less affected. In a market where digital customer acquisition costs go up across the board, the businesses with the lowest customer acquisition costs become more valuable relative to the market. This is the kind of second order effect that takes 18 months to sharpen financial data and about 36 months to become consensus understanding. By the time it is consensus understanding, the opportunity has substantially repriced. You are currently in the window where the first order effects are visible and the second order effects are still underappreciated. I want to return now to where we started because I think the opening question deserves a proper answer. The free internet was always a business model. Let me prove that in about 60 seconds. In 1994, the internet became commercially accessible. In 1998, the advertising model was formalized by search. In 2004, social media began packaging your attention into an advertising product. In 2008, the smartphone attached that advertising product permanently to your person. For 30 years, the implicit deal was this: you give us your attention, your data, and your behavior, and we give you free access to content, communication, and information. The free internet was not free. You were the product. The price you paid was denominated in attention and data rather than dollars, which made it feel free in a way that obscured the actual transaction. The new law did not end the free internet. The new law shifted the point of extraction. Instead of extracting value primarily through your attention and data, the infrastructure layer is now extracting value through usage fees. The experience looks similar, but the money is flowing through different pipes to different destinations. And when money changes pipes, the people who own the new pipes win and the people who own the old pipes have to renegotiate. Here is the most important thing I can leave you with about how to think about this beyond the immediate law. The internet is infrastructure. Infrastructure always gets monetized. The only variables are who owns it, what legal framework governs the monetization, and what the timing of the repricing looks like. For 30 years, the internet's infrastructure was under-monetized relative to its actual value. This was not sustainable in a world where data consumption is growing at a rate that requires continuous infrastructure investment. The law is a symptom of an underlying reality, which is that someone has to pay for the road. The question was never if that would happen. The question was when and through what mechanism. You can be angry about that. Lots of people are, but anger at infrastructure economics is like being angry at gravity. The toll road exists because roads cost money to build. Getting angry at the toll booth does not lower your toll. Understanding the toll structure and positioning around it does. Let me give you 3 practical things that are worth actually doing based on what we have covered, and I am going to be specific because vague advice is useless. The first practical thing, audit your own exposure to free tier digital distribution. If you run a business or a side income that depends on free algorithmic reach, you are operating on infrastructure whose cost is increasing and whose free tier generosity is decreasing. That does not mean you stop, it means you accelerate your investment in own distribution. Email lists, direct relationships, platforms where you own the relationship rather than renting attention from an algorithm. The cost of building own distribution has always been higher than riding free algorithms. But the relative cost advantage of free algorithms just got smaller. The time to build the email list is not when the algorithm cuts your reach. The time to build it is right now while you still have reach to convert. The second practical thing, look at infrastructure exposure in your portfolio if you have one. Not a specific stock recommendation, but as a category. Telecom infrastructure, data centers, fiber network operators, and the REITs that own physical internet infrastructure are the structural beneficiaries of a law that just legally expanded their pricing power. These are not glamorous companies, they do not trend, they do not have viral product launches, but they own the toll roads. The toll roads are now legally allowed to charge more. That is a fairly clean investment thesis that does not require predicting technology trends, consumer behavior shifts, or competitive dynamics. It just requires understanding that the law changed who extracts value and from whom. The third practical thing, think about what the free to paid shift means for your own consumption and your own positioning as a creator or entrepreneur. The compressing free tier is not just an inconvenience, it is a signal about where the market is going. Consumers are going to be increasingly segmented into paid and free tiers with meaningfully different experiences. The businesses that will do well in this environment are the ones that give people a compelling reason to pay for something rather than hoping they'll be satisfied with the free version forever. If you are building something, the question is not how do I get more free users, the question is how do I build something worth paying for? That question has always been the right question. The new law just made it more urgent. The toll road is built. The booths are going up. You can drive on it as a consumer, which means you pay the tolls. You can drive on it as a creator, which means you compete for cheaper access on an increasingly expensive road. Or you can own some of the road, which means the tolls come back to you. Most people will choose option 1. Some people will grind harder at option 2 and wonder why the economics keep getting harder. A few people will understand what actually changed and position accordingly. That gap between the people who understand the system and the people who experience it without understanding it is where I spend most of my time. If you want to stay in that conversation, subscribe. One button. Dry and direct. That is all I have to say about it.